defer it. There's a whole panoply of things people will do to avoid tax, including, as Travis is pointing out to you, move. So Travis, why don't we start out with what is AGI and how does it factor into what you're talking about?
Sure. Well, AGI just refers to adjusted gross income. It's for lack of a better standard term, what the government generally says is taxable. Now, there are standard deductions and itemized deductions and a number of other things that go into that, and it does vary somewhat by state. But it's generally thought to be one of the most objective standards of measure that would track the wealth coming in or out. So if I, for example, decide to move from St. Louis in this year and then move to Sacramento next year, I had a state 1040 tax return that had all my adjustments down to what my taxable income was in the state of Missouri from year one. And the next year, I will shift that and become a part or full-time resident paying that in California. As you point out, the price of work is higher here than would have been there. So we can see to a large degree what free consumer choices look like by tracking that net over a longer period, such as 15 years, what we've done here.
Okay, so but Jerry Brown tells us, your namesake, that raising taxes doesn't cause people to move. In fact, Stanford, who I generally, actually the best line about Stanford, I had three brothers who go to Stanford, and it was as Professor Ackerman says, we both went to Cal, that it's just a junior university. Leland Stanford Junior University. Came up with a study that said, no, they don't leave. Tell us, it's because that's what Jerry Brown says, he trots it out every time. Tell us what the study was based on, and quite frankly, why it's hokum.
Well, it's a very narrow crafted study, and it's since been refuted by a number of folks. In fact, if you're looking for empirical economics, there's 26 studies that I know of that all show a correlation between lower marginal tax rates and higher rates of economic growth. And then they go so much further into looking at what does the mode of taxation, the type of taxation, matter. And typically, what's undisputed in the vast majority of literature is that you do see an order of damage against production and investment. Corporate income taxes at the federal level and international level, followed by personal income taxes. Makes sense, right? Because the source of all your savings, all of your investment, all your ability to pay taxes, and all your consumer spending comes from what? Your personal income, right? Or the income that your family reports in aggregate. So, followed by that, so you have corporate, then personal, and then consumption taxes, and finally, property taxes. Interestingly enough, politically, the sensitivity to those modes of taxes is just about the opposite, because we have a lot of distance between them. So I don't put a lot of stock in the Stanford study.
Tell us what it was based on. It had something to do with marriage.
Well, the gentleman that put it together tried to compare it, and by proving that it had relevance, they suggested that they needed to induce a variable such as something else that would be very disruptive to one's life, such as divorce rates. So they proved that their regression was statistically significant by proving that divorces were disruptive as well. And it was also mainly based on a very narrow slice of looking at a narrow period where your millionaire's tax, I think dedicated to mental health revenues, were thought to be okay. In other words, not disruptive to those. Keep in mind this graph right here, that the red states are the states that are still contributing from out of California into California net over this period. So a millionaire from New York moving into Los Angeles is a part of that data collection as well. So the study that Stanford cites was very misleading. But if you are going to believe it, then there's a solution for Governor Brown, right? You should just ban divorce, because that will hold all taxpayers captive and you won't be allowing anyone to leave. Reality is, both divorce and higher taxes can be disruptive to production and earnings. So for those that are really looking at the connection between economic growth and marginal tax rates, look at the 26 peer-reviewed empirical studies that are out there from everyone from the Cato Institute to the Tax Foundation to Heritage and on and on and on.